Hi, Aseem. Welcome to the BS Banking
Hello.
Show. Good to have you here.
Thank you for having me, Raghu. Pleasure.
Yeah. Now that the IPO's out of the way, how do you see the plot ahead for your company?
So, this is the actual beginning of the journey, and for a company, there are three phases. The first phase is when you start it and get it off the ground and get the basic business model in place. In the second stage, you scale it to a point where we're still in the private market, where you scale it to a point where you raise equity from the private markets and take the company to a particular scale, and then get the processes, the governance, the controls, compliances all in place for you to be able to scale it to its potential. This is now the third phase of SBFC. It's a forever journey. We are building an institution. It should take us 20 years, God willing, to build something material. So nothing much changes. We are just more in the public eye now. Our successes and failures will be more in the public eye and commented upon. But apart from that, it is business as usual, and back to the grind, back to building what we want to build.
What do you think is the differentiating aspect of your NBFC compared to others in a highly
So,
commoditized financial services market?
so finance is a strange business where your raw material is money, and what you give out also is money, and everyone's money is the same. When you use a product, an FMCG product, the product is different. And when you use a X brand soap, it is different from a Y brand soap. An X brand washing machine is different from a Y brand washing machine. It has differentiate features. In the business of finance, essentially what we are doing is the same thing. So it is difficult to differentiate yourself on neither is technology, and also any business which is highly regulated. It cannot be very innovative. So innovation will be kept in check, and therefore your ability to really create moats around a product, a process, uh, a technology is very limited. So in the long run, the fun part of this business is that everybody does the same thing, but everybody does not get the same results. So the only real moat that you have in this business is execution. And for some reason, the business is simple, that you give out a loan and you get the money back. But it is to do this through cycles, and to do it over decades has been incredibly difficult. So if you see the history of financial services in India, if you go back to 1990s, when the first wave of NBFCs began, at any point of time between 8,000 to 11,000 NBFCs have been at it. And then 95 private sector banks came in. And then you had public sector banks consolidating. And every 10 years, there is a wave that comes where NBFCs which were not that well run or well governed go under, and a new wave of NBFCs are born. So in this business, very few have lasted decades, and that is where the magic of compounding kicks in. So what we believe is that when the business is simple, what we need to do is very obvious. It is just that we need to have the discipline to do it without slipping any quarter.
You referred to execution. How different will your housing loans be from others who went the same product?
So the product construct remains the same, so there is no difference between the product of an X. So what happens is that in India, we have the way risk-based pricing has emerged in India is slightly different from the way it has emerged in the rest of the world. In India, we have defined risk on customer segments. So there is a bottom of the pyramid segment, where the riskiness is a little higher. Then there's a middle segment, then there is a top end segment. So based on segmental, products are designed based on pricing, tenure, income estimation, etc., based on segments of the customers that you deal with. And therefore, the whole concept of affordable housing emerged in India. And affordable housing is nothing but low to middle income group housing. The product remains the same, whether you're giving a home loan to a top end customer or to a customer at the bottom of the pyramid. It is just that the way you differentiate yourself is geography. This you have to penetrate a lot deeper into geography, because a lot of these houses are self-constructed houses, unlike what happens to premium housing, which is more builder led constructions that people invest into. So for example, if you're into premium housing, you will be financing projects in Delhi, in Bombay, in Bangalore, in the big cities, where there are builders who are building construction. When you are doing the affordable segment, which is a segment that we deal with, we have to go deep into the interiors of the country and identify markets there. So one, we have to create distribution into these smaller towns. Two, we have to reach out to these customers, because in a builder segment, the builder becomes the central focal point for getting the customers in. While if you are doing affordable housing, you are actually going out into self-constructed housing financing. So therefore, you have to find these customers into these interior markets, which is a journey in itself. The third is in terms of tenures. You have to keep the EMI at an affordable level. And the fourth is in terms of pricing. This pricing is also because of income estimation. When you're doing salaried employees in the premium metros, you get a salary slip, you get Form 16, you get all the income tax returns. Very easy to assess the income of the customer and the cash flows of the customer. But when you're going into the challenge becomes, how do you really estimate incomes? And some of the income may be documented, some of the incomes may be in cash. Your ability to really understand the customer's business, the cash flows, and the ability to service the EMI. So, and then finally, it is about collecting. That you need to have the mechanism, both digital as well as physical, to be able to collect those EMIs once lent out, because your check bounce ratio will be higher than premium housing. So effectively, to sum it up, what we do is the same as what premium companies do. It is just that the way in which we do it is different, because of the customer segment that we deal with is different.
How is your coordination business coming along?
So that is when the ILFS crisis had happened, and when later the DHFL crisis happened, the banks had completely frozen lending to NBFCs at that point of time, and we were still a very young, very upcoming NBFC. So availability of bank finance was at a premium. And at that point of time, when the circular came, in 19, where they came up with the co-origination circular, we thought that this is an absolute brilliant initiative by the central bank, because it solves two problems. One is that it solves the bank's problem of originating business of a different kind that they originated from, because NBFCs historically have so NBFCs have been like, banks have been rocks, and NBFCs have been sand between the rocks, which have filled the gaps that left by the big banks. So we were very good at originating customers, but at a balance sheet level, there is a weakness, because on the liability side, you do not have access to public deposits, which the banks have. So the banks have a very smart liability franchise. We have a very smart asset franchise, and this becomes a win-win, where we are able to originate customers and 20% with us and 80% with them, and allows us to really solve. One is that we would always have to borrow that 80 rupees anyway from the bank and onward lend, which would have taken that extra risk onto our balance sheet. While here we are doing direct lending, where 80% sits on books directly of the bank. And it has taken us 2 years to really put this in place. And I would really credit ICICI Bank for really coming forward to make this work. And in 2 years, we have now reached a portfolio of about 850 crores, and 20% of our monthly origination we are now doing under co-origination. So it has worked really well for us. We had to work hard on getting the API integration done, because technology transfer has to happen, where the file digitally has to move into ICICI Bank credit buyer. Their credit buyer also assesses the file. So we get the benefit of one more, much more evolved than our credit stream looking into cases. And therefore, we benefit from their learning of the retail market over the decades. So in a sense, the portfolio really grown well for us. And hopefully we keep it at this pace, 18-20% of our monthly origination.
Before I let you go, what is the thinking behind foraying into the loan management business?
So actually, when I used to study the US markets, I would always see that in US, the originator is different. The mortgage servicer is different. And there are specialized mortgage service companies. And then this is parceled out into an MBS and sold down the line to investors. So in US, it has emerged very differently, and across the world, it has emerged a little differently. In India, somehow, even when securitization would happen, the originator would continue to be the servicer of the loan parcel. But at some point of time, when markets would mature, we would have a situation where loan managers would evolve in the ecosphere. The time for it came when the DHFL default happened, and thereafter the Reliance Twins default happened. At that point of time, banks were holding on to direct assignment portfolios or PTC portfolios of these underlying companies, which were DHFL and the Reliance companies, where because there was a risk of the originator, who's now the servicer, defaulting, the rating agencies were downgrading the PTC structure a notch. And there was also a worry that the cash flows may get intermingled or not reach them in time. So at that point of time, we sensed an opportunity and we reached out to these banks, and to some of the asset management companies who were invested, to some of the ARCs, who had acquired these assets, and said that we can actually run this portfolio for you because we are anyway an originator and we are anyway a collector. So this business we understand, we have created. We are there in 16 states. We are there in 200 odd towns. So we have the distribution to be able to collect these portfolios. So all we did was we step in the shoes of the originator. We created a middleware to allow the transfer of data from the host loan management system to our management system. We transferred the physical files, the custody of the files, the custody of the property papers, and are now servicing the loan end to end. So today, those customers call us if they need anything. We service them. We have a customer service numbers for them. We digitally reach out to these customers. We present their monthly EMIs. The EMIs straight go into the trust account or the concerned bank account. They don't touch SBFC. And we do the entire process, including loan mortgage foreclosures, including repossession, auctioning of properties, everything. So the legal process is behind. So effectively, it has worked out well for us. We have done it for multiple large Indian banks, and now a new business has emerged from there, which is as a backup service provider. So we have signed up with a few foreign banks where we are when they do the loan, when they take over a securitization transaction, a PTC structure, we come in as a backup service provider from day zero. So at the moment, we are managing about 3,000 crores of assets, and it's a business that emerged out of an opportunity. But we believe that this is a long-term sustainable business.
Look forward to having you again. Have a good day. Thank you.
Thank you. You too.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.